Do you ever look at a stock and wonder, should I buy this stock or not? Is it a good value or not a good value? I'm going to take you through the process of valuing a company using a discounted cash flow model, but you have to watch the entire video because throughout there's going to be a lot of pop-ups and there's going to be graphs and pictures and more information you're going to really need to figure things out. So let's get started. So Medtronic is a medical device company. It's mostly sells products in the United States, but it's headquartered in Ireland for tax purposes. And it operates in 140 countries and employs over 90,000 people. It was founded in 1949 in Minnesota. So to get started with the model, we first need market cap, which is 124.9 billion. And that's the value of the company according to the market. And then we need the stock price, which is 93.21. And next for the model, we need free cash flows, and that's the cash that's remaining after operating your business. So you want to really invest in a company that has free cash flows. Next, we have net income, which is the profit and loss on the income statement. And we're going to put 4 years of that into the model. And last is revenue, which is the sales. And that also goes into the model. We're going to do 4 years of revenue. And you want to look at numbers, make sure they're not negative or really volatile, because if they were either, it could make it really hard to value a company. They all look fairly steady and positive, so that's good. Let's look at the capital structure of the company and figure out how much interest they pay in their debt. They pay over $1 billion of interest on their debt. Let's see how much debt they have. We'll go to the balance sheet for that, go to the liabilities section. And the current liabilities is the current debt that's due within 12 months. And that's 2.8 billion. And the long-term debt is due after 12 months, and that's 22 billion. So they pay 4.4% interest on their debt. But interest payments are tax deductible, so let's get their effective tax rate. So the income, let's do this year. The income before tax is 5.2 billion, and the income tax is 547 million. See, income statements use accrual accounting, so it's hard to look at 1 year and figure things out. So after we deduct the taxes, they pay a little under 4% for their debt. That's the cost to them. Now, let's get the beta. That's the volatility of the stock. And you generally want a low beta. That's a really good beta, 0.68. That means the stock moves less than a market. So a low volatile stock implies that it's less risky and it's a better investment. Let's look at the current assets. That's on the balance sheet, and that's assets that can be liquidated within 12 months. And that's 22 billion. And let's look at that current liabilities. Those are liabilities that are due within 12 months. That's 10 billion. And we need the equity, and that's the value of the company according to the balance sheet. That's total assets minus total liabilities. That's 50.7 billion. And the operating income, the EBIT, earnings before interest and taxes, that's 5.2 billion. So the company has 33% debt in a capital structure. The rest is equity. So in order to get the weighted average cost of capital, it's a blend of debt and equity, and that comes out to 6.36%. And that's what we're going to use to discount the future cash flows. And we estimated 4 years of future free cash flows. And then we did a terminal value, which is all years past year 4. We discounted those numbers back to today. And we get a value of the company of $94 billion. And when we divide that number by 1.3 billion shares, we get an intrinsic stock price of $70. So according to the model, it's trading at a 33% premium. It's a sell. It's actually trading at $93. So we calculate $70. Let's look at the historical stock price. So it looks like it was trading closer to 70 maybe a couple years ago, 2-3 years ago. So it's been trading at a premium for a while. There could be a lot of reasons stocks trade higher or lower than their intrinsic value. It's what people think the future of the company is going to be. If they think the future of the company is bright, they're going to buy the stock, and that's going to drive the price up beyond intrinsic value. If people think they're going to struggle in the future, they won't buy the stock or sell the stock they have, and that'll push the price down. And people look at a lot of things to figure this stuff out. Fundamental factors is what we looked at, earnings and revenue, and there's also technical factors and market sentiment, how people feel about the company or maybe the industry or the market as a whole. And if you really think the stock is a good long-term investment, the only way to mitigate these ups and downs in the market is to just hold the stock for many, many years. Now let's look at their financial ratios. And their PE ratio is a little high. I like to see under 15. That's price of the stock over earnings per share. And the price of sales is also a little high. I like to see under 2.2. They have 4.3. That's stock price over sales per share. The price to book looks pretty good. I prefer under 3.3. They have 2.5. Of course, you want to make sure the assets are solid before just going on these numbers. Current ratio is really good. I like to see between 1.2 and 2. They're a little over 2, which is fine. That just means they have a little more liquid assets to cover their short-term liabilities. A low ROE, I like to see over 20%. They're at 9%. So they're not providing as much value to their investors as they could. Interest coverage ratio is how many times they could cover their interest payment, that $1 billion, and they could cover it almost 5 times. That's a good sign. Let's look at their default risk. 0% chance of default in the next 12 months. And Abbott Labs is in the same industry as Medtronic, so I can compare the two companies. And that's the best way to compare ratios. You don't want to compare it to the entire market, or you don't want to compare it to companies in a different sector. Compare it to companies in similar sectors that do similar things. So Medtronic wins in almost every category. They have a better PE, although it's not great, a better price to sales, a better price to book, and a better current ratio. But there are just some industries that have poor ratios. ROE, they're both pretty low, and they're both okay in debt. They don't have too much debt. And debt's not a bad thing. As long as they're using the debt appropriately, using it to grow the business and make it more profitable and better, that's a good use of debt. And Abbott is a little bigger in market cap. They're $155 billion, although Medtronic is pretty big itself. So it looks like a pretty solid company. It's just trading at a premium. So if the price comes down, I'd probably feel comfortable with buying it. But that decision is totally up to you. Let me know what you think about the video and think about the company. And thanks for watching.